Somewhere in Singapore today, someone earning $7,000 a month is sitting at a car showroom falling in love with a Toyota Corolla that costs $160,000. The salesperson tells them the monthly installment is manageable. What the salesperson does not mention is the $40,000 cash deposit they need up front, the $800 a month in running costs on top of the installment, and the fact that the car will lose around $14,000 in value every single year they own it. Nobody in that showroom will give them the real number. That is what this video is for. Singapore is officially the most expensive place in the world to own a car. Not because Singaporeans drive particularly luxurious vehicles, because of a system that layers tax upon tax upon tax before you ever start the engine. A Toyota Corolla with a 2-liter engine costs around $22,000 in the United States. The exact same car in Singapore costs approximately 160,000 Singapore dollars in 2026. The difference is almost entirely government imposed. The Certificate of Entitlement, which is simply the right to register and drive a car for 10 years, closed at $102,000 for a standard Category A car in January 2026 alone. Before you have paid for the car itself. So before we go through the salary brackets, here are the 3 rules that govern every car purchase in Singapore, and the Monetary Authority of Singapore enforces all of them without exceptions. Rule 1. Loan-to-value limits. If the car's open market value is $20,000 or below, a bank can lend you up to 70%. That means a minimum 30% cash deposit. If the open market value exceeds $20,000, which covers almost every new car in Singapore, the maximum loan drops to 60%, requiring a minimum 40% cash deposit. That deposit must be paid in full, in cash, on the day of purchase, not from a credit card, not from a personal loan, cash. Rule 2. Maximum loan tenure is 7 years, no exceptions. Longer tenures lower your monthly installment, but dramatically increase total interest paid. On a $90,000 loan at 2.78% flat over 7 years, you pay roughly $18,000 in interest compared to about $13,000 over 5 years. That $5,000 gap is real money. Rule 3. Total debt servicing ratio. Every dollar of monthly debt you carry, your home loan, your car loan, any outstanding credit, combined cannot exceed 55% of your gross monthly income. This single rule is the one that kills most car purchase plans in Singapore, because most Singaporeans already carry an HDB mortgage. Now let us run the numbers by salary. Monthly salary $3,000. This is the entry level. The minimum income banks require to even consider a car loan is $2,000 a month. The math at $3,000 is brutal and honest. 15% of $3,000, which is the maximum any financial planner would allocate to total car costs in Singapore, is $450. The minimum monthly cost to run even the cheapest car, a modest used vehicle with a few years of COE remaining, covering insurance, road tax, HDB parking, and basic fuel, starts around $720 a month without any loan repayment. You are already over budget before you have borrowed a single dollar. At this income level, a car is not a financial decision. It is a financial choice to stop building wealth. The MRT network covers the entire island. Point-to-point Grab rides across Singapore average $5 to $15. A monthly Grab subscription package for regular commuters works out far cheaper than the cost of owning and running any car. If you earn $3,000 a month and you want to build real financial security, a car is not part of that plan in 2026. Monthly salary $5,000. The median Singaporean earns $5,775 per month, according to the Ministry of Manpower's 2025 data. At $5,000, the math is tight. 15% is $750 for all car-related costs. But running costs alone for a modest car sit at $700 to $800 a month, leaving essentially nothing for a loan repayment. There is only one car ownership strategy that works at this income level: saving for a full cash purchase of a used car with remaining COE. No bank loan, no monthly installment. A used car with 4 to 5 years of COE remaining can be found in the range of $50,000 to $70,000 depending on the make and condition. That requires discipline, a dedicated savings fund, and usually 2 to 3 years of consistent saving at this income level. It is possible, but it requires treating the car savings the same way you treat your CPF contributions: automatic, untouched, and separate from daily expenses. And here is the TDSR trap most $5,000 earners walk straight into. If you already have an HDB mortgage of $1,500 a month, your TDSR ceiling is $2,750 total across all debts. Minus the mortgage, you only have $1,250 of borrowing capacity across all remaining debt. A car loan installment on even a $70,000 vehicle at 2.78% flat over 7 years runs about $930 a month. Factor in a credit card balance or any other debt, and you may not qualify for the loan at all. Monthly salary, $7,000. This is where the first real car ownership decision begins, and where most Singaporeans get it badly wrong. $7,000 gross monthly. 15% gives you $1,050 for all car costs. Running costs for a standard car land at around $800 monthly, leaving $250 for an actual loan repayment. On 2.78% flat over 7 years, $250 a month supports a loan of roughly $19,000. If you are buying a car with a low open market value at or below $20,000, you can borrow 70%. On a car priced at $63,000, that means a loan of $44,000. You cannot support a $44,000 loan on a $250 monthly payment. What actually happens at this income level when you have an HDB mortgage of around $1,700 a month? Your TDSR ceiling is $3,850. Minus the mortgage, $1,700, you have $2,150 in remaining debt capacity. A car loan of $44,000 at 2.78% over 7 years costs $580 a month. Combined with your mortgage, that is $2,280, which clears the TDSR threshold at 59%. That fails. The only way a $7,000 earner owns a car with a mortgage is either with a smaller mortgage, a co-borrower spouse with additional income counted in the TDSR, or a significant cash contribution that reduces the loan size substantially. If you do qualify, the realistic car for $7,000 a month is a used Category A vehicle with 5 to 6 years of COE remaining, priced between $60,000 and $80,000, with a 30% cash deposit of $18,000 to $24,000 saved up front. Not a new car. Not even close. Monthly salary, $10,000. Here, the picture changes meaningfully. $10,000 gross monthly. TDSR ceiling, $5,500. If your HDB mortgage is $2,000, you have $3,500 of debt capacity remaining. A car loan on a Category A new car priced at $150,000 with a 60% loan of $90,000 at 2.78% flat over 7 years runs approximately $1,190 a month. That keeps you well within TDSR. But it demands $60,000 in cash for the 40% deposit paid on the day you sign. If you have $60,000 saved, earn $10,000 a month, and your HDB mortgage is under $2,000 a month, a new Category A car is financially possible. Running costs on a standard sedan will add another $800 to $900 monthly on top of the installment. Total monthly car commitment, around $2,100. That is 21% of your gross income, tight but manageable if every other part of your financial life is in order. Monthly salary, $15,000. This is Singapore's top 10%. The Ministry of Manpower's 2025 data puts the top 10% income threshold at $15,540 monthly. At $15,000, the TDSR ceiling is $8,250. With an HDB mortgage, even a larger one of $2,500 a month, you retain $5,750 in monthly debt capacity. A Category B car, the larger engine class where COE closed at $119,100 in January 2026, puts a typical vehicle price between $210,000 and $250,000. 40% deposit on a $220,000 car is $88,000 cash. The remaining 60% loan of $132,000 at 2.78% flat over 7 years runs approximately $1,740 a month. Combined with a $2,500 mortgage, your total debt service is $4,240, or 28% of gross income. TDSR passes comfortably. Running costs on a Category B car, better insurance, higher fuel consumption, premium parking, run closer to $1,200 to $1,500 monthly. At this income level, a Category B car is a financial choice, not a financial stretch. But it still requires nearly $90,000 in cash available upfront. That money sitting in a Vanguard FTSE All-World ETF at historical returns of 7 to 8% annually would become approximately $176,000 over 10 years. The car will be scrapped for almost nothing under the revised 2026 PARF rules, which now return only 5% of the additional registration fee at the end of 10 years, down from 50% before February 2026. That PARF change is significant and new. Cars registered after the 20th of February 2026 carry dramatically higher real depreciation than any car bought before that date. Monthly salary $25,000 and above. This is the top 5% of Singapore income earners. Here, the conversation is no longer about whether you can afford the car. It is about whether owning a car is the best use of the capital. At this level, Continental cars, Mercedes-Benz, BMW, and Audi become financially accessible in pure cash flow terms. A BMW 5 Series in Singapore prices between $280,000 and $330,000 in 2026. 40% deposit of $112,000 to $132,000 is required in cash. Road tax for a larger engine steps up significantly. Insurance premiums on Continental cars start at $3,000 annually for experienced drivers with no claims. Depreciation on a Continental car runs between $20,000 and $45,000 per year, making it the single largest cost, dwarfing fuel, insurance, and ERP combined. The real question at $25,000 a month is not affordability. It is opportunity cost. $120,000 of deposit capital invested in Singapore REITs yielding 5 to 6% annually produces $6,000 to $7,000 of annual passive income indefinitely. The car produces nothing except the ability to avoid taking the MRT. Here is what separates people who build wealth in Singapore from those who look wealthy. The people who build real financial security here do not buy cars when they first can afford them. They buy cars when the decision to do so does not affect their savings rate, their CPF top-ups, their investment contributions, or their emergency fund. They buy used over new to avoid the steepest depreciation curve. They save the deposit in advance as a discrete lump sum rather than borrowing or redirecting money from other financial goals. And they calculate the total 10-year cost of ownership, not the monthly installment, before making any decision. The monthly installment is the dealership's number. The total 10-year cost is yours. Here is what to do before you go near a showroom. Check your TDSR position first. Add your current monthly mortgage or rent to your existing loan commitments. Subtract from 55% of your gross income. What remains is your maximum available debt capacity for a car loan. Then calculate the cash deposit you would need. For any car with an open market value above $20,000, which is almost every car in Singapore, you need 40% of the total vehicle price in cash before you qualify for a bank loan. If you do not have that cash sitting in a separate account today, you are not yet in a position to buy. The MRT is not a consolation prize. In Singapore, in 2026, it is one of the most financially intelligent commuting choices you can make. If this gave you a clear picture of where you actually stand, hit that like button and subscribe to the channel. I will see you in the next one.